Brett, a negative day on the JSE again, though we have come off our worst levels. We've also seen the Dow Jones in New York heading into the green, and European markets also turning around a little bit. But it looks like it really is a risk-off environment at this stage.
Yeah, well, we had a bit of a shocker on Friday, and I think all of us came in expecting the markets are a little bit weaker today, obviously with all the problems in the Middle East, a lot of concern in the markets. Markets were down about 300 points, seemed to find their legs midday, coming back. I think that the weaker rand kind of buoying some of the resource stocks, and that really taking us to about 100 points down when I left the day. So not too serious. One would have expected a little bit worse coming into it, actually.
Well, we saw a couple of months ago when we had tensions building in the Korean peninsula between North and South Korea that we had a pullback on the markets. We had a bit of risk aversion. Do you think this is a case of more of the same, that investors are just looking for an excuse to take profit?
Look, I think there is a little bit of that the markets have had such a nice rally now. You know, this is a good reason, to bank some of those profits. But, it does seem a little bit more serious than what we saw. The big thing here is the contagion effect. Obviously, these problems originating in Tunisia, overflowing now into Egypt. We don't want to see too much more contagion. So I think the markets are a little bit more nervous about this, and we're going to have to see how it plays out over the next week or two.
Would you expect a bit of consolidation at these levels? Would you expect a bit of a bigger pullback?
Yeah, look, I wouldn't be too concerned about a bit of consolidation. A 25% rally in 3 or 4 months. If you saw even as much as a 5 or 10% consolidation, that would be considered healthy. So at the moment, the way things are playing out, I'd see it as a buying opportunity. If it was to come off another 300 or 400 points, I think you're starting to see a lot of value come out in some of the stocks. Something
that's puzzled me is the gold price not really reacting to the tensions we're seeing in the Middle East. So still trading around those $1,330 an ounce levels, and still quite far off from those all-time highs hit late last year.
Yeah, well, I think gold had also broken down a little bit. It had come off a technical level. 1340 was the 100-day, and it had fallen quite sharply down to the 1315 level, and it's bounced off that. I think if the tensions do escalate, you will see gold pick up. But I think naturally gold, once again, also was consolidating. So, yeah, you would expect the gold price to pick up with a little bit more concern there, but we'll have to monitor it.
Well, you mentioned those resources stocks turning positive today. We had Harmony, BHP Billiton, African Rainbow Minerals, 3 top gainers on the top 40. One that doesn't stand out there, though, is Sasol, ending 0.5% weaker. Now, we've got the oil price heading towards $100 a barrel. We have the rand weakening to 720. I would have thought Sasol would have benefited from all that.
Yeah, I tend to agree with you. I was also a little bit surprised at the price action in Sasol. It wasn't down very much. I think it was only off a rand or two. But certainly, with the weaker rand and the higher oil price, one would have expected it to be up a little bit. I can't really give a reason for that one, Steve.
Some other news out today. PPC sales update. Shares were down 4.5% early this afternoon. SA cement sales down 5% in the December quarter, and PPC really fitting in with that. So not boding well for the cement or the construction industries, really.
Yeah, construction seems to have been going through a bit of a torrid time. We saw Murray's coming out with that trading update on Friday. That didn't do them any favours. They were also very weak today. And PPC, a little bit of miss there on their sales figures, I think 5% down, and the stock also getting hammered.
Murray and Roberts, of course, further down 12% this morning. That was on top of the 13% fall on Friday. Do you think the slide we've seen in that Murray and Roberts share price is justified given the news we saw out of them on Friday?
Yeah, I mean, it is a big concern. You've got 3 big projects where they're starting to question the revenue that they're going to be recognizing out of those projects. That's caused a huge amount of uncertainty in the market. I mean, it's not often that you see a stock like that literally fall off the end of a cliff. And we saw no real slowdown in the selling today. So there's still a lot of nervousness, and I think you're going to see that out until the results come out. I think that's sort of late February that's coming out. For the speculative punters out there, maybe you're going to get some opportunities, but certainly it doesn't look like we're out of the woods there yet.
Of course, this follows a trading update from Group 5 just a week or so before that Murray and Roberts trading update. So it doesn't really bode well for the construction sector, even if you strip out those payments that Murray and Roberts hasn't received yet from some of those projects. It looks like the construction sector is still very much in the doldrums.
Yeah, and we saw Wilson Bailey also under pressure. I think that's the case. I mean, I think the construction stocks are quite cyclical, and we're going to have to wait for the cycle to pick up again for them. We're seeing them really pricing in a lot of bad news. I mean, these stocks are on 5 and 6 PEs. So, for the longer term investor who's willing to hold through this kind of doldrums, I think there is some opportunities there. But it doesn't look like the worst of the news is out yet.
Brett, the three biggest losers on the top 40 today, Pick n Pay, ShopRite and Truworths, losing between 2.5% and 3.5% between the three of them. Why are the retailers under pressure again?
I think if you have a look at it, last year the retailers were the darling of the market, really putting on very strong performances. Now we see that we've come to the end of the interest rate cycle. The next move in interest rates is going to be up. And I think a lot of the froth being taken off from that market. So you've seen it across the board. You've seen sort of like 10 to 15% consolidation. So these stocks still on 15 and 16 PEs, so they're not super cheap. And I think just really people rebalancing their portfolios. If we're seeing a little bit of risk off in the markets, these have been the performers. Easy to sort of sell out some of your performers and heading to cash and then wait and see what happens.
Well, given the trading updates we've seen from the retail sector, I think they're going to start reporting towards the end of next month. Do you think the PEs are justified given the earnings and revenue that they've grown over the past year?
Yeah, look, I think that they are starting to show some value there. I mean, if you have a look at some of the credit extension numbers that were coming out, that's really being driven by the consumers. And I saw even Mr. Price coming out today with 10% up revenue numbers from last year. So I think, the stocks are priced for success, but I don't think that the PEs are too high to make them in unaffordable territory at this point.
Capitec coming out today with the results of its rights offer. This is a rights offer that it announced last November. It's raised just over R1 billion, and it looks like the rights were pretty well taken up.
Yeah, very positive for the company. I think the rights were well taken, R1 billion, as you say. Really, we're seeing Capitec and Able really coming to the fore from the ranks of the banking sector and really starting to make a move on becoming major players over the next few years.
So within the banking sector, would Capitec still be something you'd put your money on, or do you think it's run a bit too hard?
Yeah, I think that the stocks had a very nice run. I think you really have to buy into their growth prospects going forward. I think it's fairly valued to me. I wouldn't be rushing to put my life savings in at these levels.
Brett, just with the pullback we've seen on the markets over the past week, do you think this is a bit of a buying opportunity? Should investors be buying into the pullbacks that we see at this stage?
Yeah, I would certainly be easing in at this point. If I'm coming in with new cash, I think you can be accumulating. I'd like to see, we've seen a bit of a sell-off. The next support's about 300 or 400 points below where we are now. So I think it would be quite healthy for the market to come off a little bit more, and then you can buy with a little bit more certainty around there. But certainly the lesson we've had from the last few months is to buy on the dips, and I would expect, if there is much more of a sell-off, that you'll see buying coming into this market.
And your view on the rand going forward, because if we do see continued weakness for the currency, that must bode well for the resources stocks. How are you playing the rand at this stage?
Yeah, well, big technical level for the rand. Funny you should speak about it. I think the 200-day moving average coming in on the rand dollar, that's around 721. I think we're sitting around 719 when I left the desk. If we do test that and test it quite effectively, I think you could see the rand weaken to 740 in the short term before sort of starting to consolidate again. So overall, I don't think the rand's going to fall out of bed, but it looks like a little bit of weakness for the foreseeable future.